There's a tax deduction that could save you up to $5 per square foot just for upgrading lighting, HVAC, or insulation. One of my clients saved $500,000 on a project he was already doing, and he nearly missed it because he found out just a little bit too late. The strategy? It's called the 179D deduction. And if you own, operate, or even design commercial property, this could be one of the most underused tax incentives available for you right now. In today's economy, finding legitimate ways to reduce your tax burden isn't just about saving money. It's about creating breathing room in your business. It's about funding growth without taking on more debt. And it's about staying competitive when profit is getting squeezed from every direction. So let me walk you through what 179D is, who qualifies, and how we helped Greg, a real estate investor buddy of mine, unlock $500,000 in deductions. I'm Rich Smith, and I help business owners, investors, and high net worth individuals use the tax code the way it was actually written to reward smart planning. So back to Greg. He owns a 100,000 square foot mixed use commercial building just outside the city. Office space downstairs, warehouse in the back, and a few residential units up top. The building's been a solid performer for him, but like any property that's been around for a while, systems start to show their age. Last year, we ran a cost segregation study for him and picked up some 45L credits for the residential units too. He thought he was tapped out on tax strategies for this property. So flash forward to this year, he was planning a $600,000 upgrade to the lighting, HVAC, windows, part maintenance, part modernization. Nothing flashy, just standard upgrades that any building this size would eventually need. Over lunch one day, I asked him, have you looked at 179D for these upgrades? He gave me that look, you know, the one like I'm speaking another language. He said, isn't that something only for government buildings? I thought private owners couldn't touch that. And that's what a lot of owners think. And it used to be true years ago. But today, those involved in real estate like Greg can claim this deduction if they meet the right energy standards for their buildings. And I said it earlier, but yet even designers of government and nonprofit buildings, think engineers, architects, system specialists, if the right documentation is in place, they can also claim this too. Now, I could see the gears turning in Greg's head. This wasn't a small property. If we could make this work. So I connected Greg with John, my favorite architect. He's one of those guys who can look at a blueprint and instantly see where energy is being wasted. The kind of person who walks into a room and immediately notices inefficient lighting and poor ventilation. So John ran an energy model of Greg's building and found that with minor design tweaks, we're talking LED spec adjustments, HVAC zoning improvements, strategic insulation upgrades, they could hit the IRS thresholds for 179D. And the impact, $500,000 in tax deductions. For upgrades Greg was already planning. Before 179D, Greg's $600K upgrade would have depreciated over decades. After 179D, it became an immediate $500K deduction worth about $185K in real tax savings that same year. Same upgrade, better timing, massive impact. Let me break it down. 179D applies to 3 systems: interior lighting, HVAC, and hot water systems. The building envelope, think insulation, roof, windows, walls. If your upgrades improve efficiency to a certain level and you meet prevailing wage and apprenticeship rules, you can deduct up to $5 per square foot. Greg's building was 100,000 square feet. He met the full criteria. That's $500,000 in write-offs. That's not a rebate, it's not a credit, it's a straight deduction against your ordinary income right now. Why does this matter? Because a deduction this size doesn't just reduce your tax bill, it can eliminate it entirely for the year, freeing up cash you can reinvest immediately. But here's what separates this from a typical green building initiative. You don't qualify just by buying the right equipment. You qualify when you plan early, when the energy model is built, certified, and verified before installation. And that's where most owners miss it. They call in December with that end of the year tax panic in their voice. They've already installed the systems, no energy model, no allocation letter, no time left to run a third-party analysis. And the deduction? Just kind of gone like that. Greg, he avoided this mistake because we were having this conversation in Q2. when there was still time to do it right. Now, let's talk about documentation, because this is where people either lock in the win or lose it all. I brought in Ted, my go-to compliance expert. He's the one who makes sure everything lines up with the IRS standards, the modeling, the certification, the inspection. He and his team oversee all of it. Ted always says something I like to repeat often to clients. The documentation is just as important as the upgrade, because without that, 179D falls apart. It's a high-value deduction, which means the IRS expects high-integrity reporting. Ted's team handles everything, runs the models, locks in the third-party certification, produces the full package. And yeah, Greg got a clean, defensible deduction, and that feel-good feeling that it would hold up under an audit. When he saw the final numbers, he said, "This is going to cover a full-time new hire for the year." That's when it hits. This isn't about saving money, it's about creating capacity, liquidity, options. It's about doing what you were going to do anyway, but doing it smarter. Now, let's talk strategy. If you're a building owner and you're planning upgrades this year, stop thinking of them as expenses. Think of them as tax-leveraged investments. A well-planned $400K HVAC upgrade could yield $200K or more in deductions. And if you're an architect or engineer working on public or nonprofit buildings and your designs qualify, you could be allocated that deduction, even though you don't own the building. We've seen this with school projects, fire departments, VA clinics, courthouses, hospitals. Designers who document it right are getting six-figure deductions for work they're already doing. Let me give you another example, completely different from Greg's real estate business. John, the same architect who helped Greg, also works with public and non-profit medical facilities, small hospitals, outpatient clinics, research labs. The kind of projects that aren't flashy, but still qualify for serious deductions under 179D. At first, he wasn't even thinking about claiming anything. He figured, I don't own the buildings, I just help design them. But that's where this gets interesting. For public and nonprofit projects, the deduction can be allocated to the designer, the architect, engineer, or a system specialist. So as long as the building meets those energy standards and the paperwork is in place. So yeah, we walked John through it all. We looked at his last year of work, about a half dozen projects ranging from 20,000 to 80,000 square feet. Clinics, rehab centers, medical office buildings. Most of them already had the design features to qualify. They just hadn't been documented properly. Once we dialed all that in, John was eligible for over $160,000 in deductions for work he had already done. No design changes, no lobbying, just smart documentation and timing. And for a solo firm like his, that deduction didn't just lower his tax bill, it helped him hire a project manager and freed up time to take on bigger, more profitable contracts this year. So here's the deal. 179D is a tax deduction up to $5 per square foot for qualifying energy efficient upgrades. It applies to owners and designers of commercial, government, and nonprofit buildings. But you must plan ahead. The deduction hinges on certified energy modeling and third-party documentation. When done right, it can turn a standard upgrade into a powerful tax incentive that creates real competitive advantage for your properties and projects. So if you're thinking, I'm already planning a project, or we're redesigning our medical systems, or we've got a public sector client on the calendar, then this is your time right now. Not next year, not December 31st, right now. Look, I've seen too many clients come in too late with that mix of hope and desperation in their eyes. Can we still make this work? And sometimes the answer is no, the timing's off, the documentation isn't there. So if you think your property or project might be a good fit, then check out the link down below in the description, answer a few questions, and we'll help walk you through your options and get you on the right path. Because the best tax savings don't show up in December. They're earned in Q2 when you still got time to plan. And remember, this isn't just about tax savings. It's about choosing to be strategic rather than reactive with your business. It's about understanding that sometimes the timing of a decision is worth even more than the decision itself. Every year I watch business owners scramble at the end of the year trying to find last-minute deductions. And every year I have to tell some of them, if you'd come to me in March or April, we probably could have saved you six figures. Don't be that person. You've already made the smart move by thinking ahead. Let's take the next step and make your project work harder for you. Think your building or project might qualify? Click the link down below to find out. Don't leave six figures on the table, because if you've ever said, I just wish somebody would have told me that sooner, this is that moment. All right, as always, I'm Rich, and until next time.